What's up, people? Welcome back to Invest with T Claus. My name is Tevi, and this is a channel dedicated to my investment journey, along with coverage on Tesla, Nio, Virgin Galactic, and ChargePoint. Come for the information, stay for the random clips. So this week has been one eventful one, from the Nasdaq and S&P 500 hitting brand new all-time highs, to big techs having their earnings, so think Amazon, Google, Microsoft, and they all managed to impress. And finally, what I've been waiting for, the Nio and Tesla earning call, and we've got some solid takeaways from those. So in today's video, we're going to be covering what those takeaways were. We'll then get into some rapid fire news around ChargePoint and the crypto world in general. Then we'll get into a discussion of the macro environment for the current market and what to do about it as we move forward, and wrap things up with a weekly performance review by percentage gain or loss for the portfolio. All right, with that said, let's get into it. Getting right into it, first up we have Tesla, who beat Wall Street analyst estimates by a comfortable margin. Wall Street was looking for an EPS of 79 cents. Tesla came in at 93, crushing expectations. Revenue grew year over year by 74%. Vehicle margin improved from 24.1% to 26.5%, meaning that they've improved their manufacturing efficiency. So think gigacasting and other improvement of that sort are actually paying off big time. Last but not least, Tesla now has an installed capacity of 1,050,000 vehicles out of the Fremont and Shanghai factory. But now, to be clear, that doesn't mean that they can produce that many cars. It simply means that if everything was working perfect, they never took a holiday, they never did maintenance or anything, that's the number of cars that they could pump out. So just to make that clear, that's not what they are guiding towards to. It's just the installed capacity at this point. So why did the Tesla stock price drop from where it was down to 710 as the week went on, even though they blew their earnings? Well, there's a couple of things at play. Number one is there's still some negative press around the Texas accident and the fact that people believe that autopilot was at play, even though there's overwhelming evidence that that's likely not going to be the case here. Number two, and probably the biggest knock on Tesla's performance this quarter, was the quality of their earning. And that's because they were able to register and account for a lot more regulatory credits this quarter, as well as the sale of some Bitcoin, about 10% of their current holdings, which they were able to recognize as profit. Now, there's a multitude of reasons why I don't agree with that, but the one thing that I will point out, because I think it's important to understand, is the whole ZEV credit, or zero emission vehicle credit, that Tesla gets for basically producing nothing but electric cars, and the fact that they are selling those credits to legacy auto. Now, Tesla bears will try to make the case that because Tesla is capitalizing on those credits, they would not be profitable otherwise, right? They need those ZEV credit in order to be profitable and keep the business going. The reality is, and how you really should be thinking about this, is that if Tesla is able to recognize a lot more credit, ZEV credit, in this quarter, it means that legacy autos, so your GMs, Fords, Volkswagen, all those automakers are actually not meeting the necessary quota to not get penalized in a major way by governments around the world, right? They're not meeting the carbon emission requirements. And therefore, they have to buy credits from Tesla in order to minimize the fines or just not pay those fines. So an increase in those ZEV credit that Tesla is able to recognize means that legacy auto is falling further behind. So it's a different way to think about it, which is the actual right way to think about it. So I'm not gonna spend any more time on that, but that was one point that I thought was interesting. We keep getting that narrative around Tesla is not profitable, they need the regulatory credits, when in reality, it means that the longer they're able to recognize those, legacy auto is just not catching up. They're not building enough cars to not need to buy from Tesla. So let's just make that clear. Moving on to Nio. Nio's result impressed in a major way. Total revenue grew 481.8% year over year. Vehicle margin improved from 17.2% in the previous quarter to 21.2%. Only company that has better margins than Nio at the moment is Tesla. That's huge. As I said before, it's Tesla in that number one spot and Nio is number two. And as far as I'm concerned, the only name that will be able to challenge Tesla in the future is going to be Nio for that number one spot. Now, Nio guided to 21 to 22,000 deliveries for Q2, and we now know that for April, they delivered 7,102 cars in the month of April, which is huge, right? So this puts them on track to hit that target and actually give them a little bit of leeway moving forward. Nio ended the week with their stock price at $40.12, which is a 2.98% increase for the week, and I would expect that as we get into Monday and beyond, that momentum should carry forward. But the main takeaway for me for this earning call is that Wall Street consensus was a loss of 16 cents. Nio actually came in at a loss of 4 cents. So they're getting that much closer to profitability. And if I had to guess, I would expect that by end of Q2 or Q3, we could potentially see Nio achieve profitability. And that in itself would be a major, major feat. The bottom line here is that both Nio and Tesla set themselves apart from the competition when you look at these results. While everybody else was busy shutting down factories and guiding to lower results in the coming quarters, they either stuck with their guidance or increased it. And the best representation for me of how these two have been navigating the obstacles in front of them and moving past them is this. Simply epic. That's Tanjiro from Demon Slayer using the total concentration technique to focus and apply fluid movements with only one goal in mind. And just like him, Tesla and Nio slayed this quarter performance, and it's only gonna get better from here. Anyway, I'm getting too hyped. Let's get back to the video. So getting into part 2 of this video, let's now talk about ChargePoint. And we expect their earning call to take place on May 27th. And even though I haven't done too much talking about them recently, doesn't mean that they haven't been busy. It's actually quite the opposite. They've been focused on expanding their network as well as forming new partnerships. And some examples of that starts with the Natso partnership, where they installed 150 new DC fast chargers along truck stops and travel plaza on US major highways. And that partnership is slated to last through 2030 with an expected 4,000 new locations for their chargers. Next up, we have Android Auto integration into the ChargePoint software. So that's their app. Now you can use Android Auto in your car, which is pretty cool. Another big one is the GM partnership, which will integrate the ChargePoint network into the GM in-car app. So Altium 360 is what they're calling it. Think of this as GM leveraging the ChargePoint network and their existing infrastructure and basically doing something very similar to the Tesla supercharger network, but for GM customers. So pretty cool. I think it's a smart move on both GM and ChargePoint to partner up and, use what's already there. So I think it's going to go a long way. Last but not least is the Daimler partnership with ChargePoint. And this was announced recently in the last week or so. Daimler and Portland General Electric unveiled their first full-scale electric truck charging station. And for this project, they went with ChargePoint, and that's pretty cool. There's a lot more examples out there, but you get the idea. Again, they've been busy, and we'll have to wait to see on the earning call how all that translates down to the bottom line. Moving over to the crypto world, first up we have Ethereum. And Ethereum this week has been on a tear, record highs after record highs, and at the moment the new all-time high is $2,955. And that can be attributed to a few things. First up, we have the implementation of the next phase of the Ethereum 2.0 network, and the upgrade was successfully tested. Next, we have more integration between the Ethereum network and the Bitcoin network. Last but not least, we have a report of increased network utilization by other stablecoins. And in case you haven't been paying attention, Ethereum is actually on track to go past the $3,000 mark. As I'm recording, we'll see if that happens. But ultimately, the price target for Ethereum in 2021 by year end is $10,000. Something to keep in mind as you're evaluating different investment options. Moving over to Bitcoin, we have confirmation that Nexon, a giant gaming company in Japan, has now officially converted a little bit more than 1% of their free cash on hand on their balance sheet into Bitcoin. And if you recall, the price of Bitcoin is targeted to hit $100,000 by the end of the year under the assumption that most corporations or many corporations convert at least 1% of their balance sheet into Bitcoin. It looks like we're on track. This is company number 35 now that has added Bitcoin to their balance sheet, and this momentum is only accelerating. Last but not least to mention here is, of course, Dogecoin. So Dogecoin last week was trading around the $26 to $27 range, and since then has made a massive move upward. And at the highest point throughout the day earlier, hit 40 cents once more. So the thing to look into for Dogecoin as we get into next week, and this is going to be a major catalyst, it's either going to pan out or not, so don't hold me to this, but Elon Musk is set to host SNL next week on May 8th. And he dubbed himself the Doge Father, so you know he's going to be talking about Dogecoin. More than likely, if this happens, I can foresee the price of Dogecoin hitting a brand new record high. So again, don't hold me to it, but I would stay close to your phone and your account as SNL is going live and Elon takes the stage. All right, so the last thing I want to touch on here before we get into the weekly performance review is how should we be looking at the market from a macro perspective? And I've mentioned before that it's important to understand how institutional investors look at the market, react to the news and what's going on around it in order to be successful as you're investing. And so there were four major things that took place this week. The first one was obviously all of the earning calls from big corporations. Second one was the address from Jay Powell, always instrumental. Third, we had the address from President Joe Biden, his first State of the Union address. And finally was the GDP number as well as the jobless claim numbers that we get on a regular basis. So all of those play into how institutions and pretty much everybody looks at the market. So as we move forward and we keep hitting those record highs, you're going to hear more and more talks about pullbacks, people taking profit, and so on and so forth. But it's all within a specific context. So I'm going to play this clip from Tony Dreyer, and I'm going to cheat here with my notes, but Tony Dreyer is the chief market strategist and head of the US micro group at Canaccord Genuity. So take a listen, and then I'll come back with what my thoughts are and what you should do as you move forward.
But our next guest is on high alert. He says the markets are due for a pullback. Tony, great to have you with us.
Thanks for having me, Mel.
Last time you were here, you were sounding, cautious as well. Is there anything about earnings season, Tony, that you're watching that could change your mind or maybe makes a stronger case for what you're predicting?
No, it's exactly the same. I think I was on the show the day that we made that tactical downgrade. It's very different than a fundamental downgrade. This is not a call that's based upon there's risk in the tape from a fundamental basis. It's not like credit's having a problem. Credit is incredible right now. There's excess liquidity. Earnings are blockbuster. We raised our earnings estimate for 2021 by $2.50 up to 178.50 about a month ago. There's nothing that's saying that this is a horrible environment. You got to be careful. All is lost. It's definitely not that. It's that everything is so good that it creates a condition that's ripe for a pullback. And as you know, one of my favorite lines that we use on the show is corrections only feel natural, normal, and healthy until you're actually in one. And then all of a sudden, when you're down 2%, you start to get scared. So I'd rather be prepared for it, even if it's a little bit early. Honestly, if I'm doing my job right, I've got to be early. I'd rather have people take some profit. This isn't a go short and sell and bet against the market. No way. This is a take a little bit of profit because the market's up so much.
So the point that he's trying to make here by stating that this is a strategic decision is that assuming that you haven't been panic selling and exiting positions left and right randomly, you should be up a decent amount or significantly on your positions. That allows you then the flexibility to trim a little bit earlier than the rest of the market and have some cash on hand, right? Before everyone else decides to trim because everything has been going up so much. At that point, when everyone else does decide to finally take profit, which automatically induces a pullback, call it of about 5%, you're ready with cash in hand to take advantage of that dip and buy it in a major way, right? And then boost your portfolio upward. Now, I will add a caveat to that, and I will say that unless you have something that you actually want to spend the money on, it doesn't make sense to trim, right? Keep your money invested, keep it moving forward and working for you. Now, if you don't have capital and a good opportunity does come along, then yes, it does make sense to trim a little bit, especially if you're up 2%, 200%, 300% on a position. Trim some of that, have the cash ready, and then as maybe one of your wish list stocks drop, go in, buy some of that. That's basically what I did with Nio, and keep everything moving upwards. So what does it look like if it's done right? Well, it just so happens that earlier this week, I did trim one of my positions where I was up about 300%. And some of that cash was reinvested into Ethereum before it moved up, as well as ChargePoint and Virgin Galactic. So let's take a look at the weekly performance. All right, so getting into the weekly performance review, and I'll bring it up on the screen here. So I'm not going to go through every single movement here, but you can see that there's multiple low points throughout the week. And those pretty much correspond with each of the major events that we've mentioned earlier in the video. So Jay Powell's address, President Biden's address, as well as the GDP number and jobless claim numbers. And each time that we went from a peak to a valley, there's about a, call it a 5% or so difference. And so at each one of those very low points, I did buy some stocks or crypto, and that ultimately translates to a positive momentum for the week, or a gain of 11.65%. So all in all, excellent week. Couldn't be any happier. All right, people, this will do it for today's video. If you enjoyed what I had to say and found the content insightful, please drop the video a like and share with your friends on social media, as it greatly helps the channel grow. For my newcomers, remember to hit that subscribe button and ring the notification bell so that you don't miss any future content. As a reminder, I post every Sunday, and as always, thank you for watching. Stay humble, hustle hard, and I'll see you in the next one.